Hello, everybody. How's everyone doing? How you feel? What's new? Everyone doing okay? Deepak, Shahab. Hello, Sinatra. So the debate yesterday was, were we going to head up one more time towards this 200-day moving average in the S&Ps or not? Just talking about it during the face webinar yesterday. 2900 was kind of sealed it, but definitely 2920 was part of it, something we talked about. Steve was already short. Had a feeling turnaround Tuesday could work with this. Was a pretty important day. Although we're rebounding today, if yesterday is going to mean something, I don't think that we should close back over this 2900 former support level. Could be resistance, and that we're probably headed back down towards 27.5, maybe 26.5, and some of the bears are even talking about there's some kind of gap around 25.5. But here's some daily moving averages. You know, they'll come in around here. It's quite a bit lower, 160 handles from where we are right now. So to me, I think yesterday was important, and you could sell rallies being wrong over yesterday's highs, looking for some type of correction of this. Okay. Grega was on earlier in the week. Identified this as the end of wave 4, wave 5 to new highs, but now we get some type of corrective action before we start talking about new highs. Dollar continues, in my view, to look weak. Looks like we had a little bit of a failing rally here yesterday when it tried to bounce. Still think that we could head back down towards major support. And really, I think a weak dollar can be supportive of the market because of basically nominal gains, and you know, a lot of transnational corporations do not like a strong dollar. So maybe we're going to get a break back down to these levels. If you saw Grega yesterday, that too was a possible scenario for a retest of these lows, even take it out before we get a bigger rally to the downside. 95, 96 won't happen. Okay, you say that with a lot of certainty. So, you know, I never do. Rarely do. I won't say never. But to say something won't happen and be a trader kind of makes you vulnerable to what the market is like, where everything will happen and anything can happen. So I think it's better when you're trading to keep an open mind. I know we all have biases, but keep that in mind. If you've been doing it long enough, you've seen everything happen. So we're always reassessing new information, new patterns, new signals. It's a living organism, a trade, and it's always changing, and you have to reassess. And as the master W.D. Gant said, if you don't learn how to change your mind, you won't have any change left. And we all know, you know, if you're a poor guy like me, you may have to go to the laundromat and you need change to feed the washer and dryer. So you don't want to be left without change, and then you don't have clean clothes.
That's very well said, Dale. Good morning, man.
Yeah, it's good to have quarters. I don't think COVID sticks to them as much as it does to $100 bills. Anyone know that? Estelle, do you know that? COVID on, do people disinfect their change now too? So anyway, those are kind of my views. I still think that if gold's going to make a move, if you're bullish gold, this is a perfect opportunity for it to finally get through this triangle with the dollar continuation move. So keep an eye on this. It measures 80 bucks, this formation. I don't think we're going to get the 80 bucks, but we could make a new high. So watch this. I think it's in Elliott terms, you'd call it a wave 4 triangle. And wherever it ends, it's a fifth wave terminal thrust. Keep an eye on that. And oh, okay, one more thing. Hi, Kevin. US dollar yen, this is going to be important. You know, came off. I'm trading on the thesis that what happened from here at 106 to almost 108 is the beginning of something to the upside. So I'm viewing this as a retrace to buy. 61.8 comes in around 106.70. And what do we need for a 2-week reversal? By Friday, we need this market closing back over 691. So, I mean, that's where we're at. One other thing, I know I've taught it to a lot of people. It's pretty simple, but you've heard me talk about off numbers. And God, who did I learn this from? Oh yeah, a guy named Eric Haydick out of Naperville, Illinois. And what you do looking for 2-week reversals, you take this week's candle. This is free, and I normally charge $99.99. Yeah, 2-week off number. So you just count back 2 candles. You could use it on any time frame, but I mainly keep an eye on it on weeklies, although I'll look for any reason to rationalize my position. If I could find it on a daily or 4-hour and it agrees with me, I use it. So anyway, coming into this week, this off numbers certainly didn't look likely. 2 weeks ago, we closed at 2830.4. And yesterday's low was 2832, close enough for government work. What you need for 2-week reversals by Friday, closing under this 2830 level. But these off numbers can also be targets. They could be entries, but you know, just a little tool to put in your toolbox. Yeah, Eric will use the tick chart. Yeah. What people do is they'll put on a position, then they'll start asking everyone what they think to give them confidence about their position. You better have confidence before you click the mouse and not look for it afterwards. So part of what I say is, you know, just humor, but, you know, challenge the market, do your work. This trade in the S&P was mapped out on over the weekend. Your best trades are planned. So don't have this attitude. I hope this one works. Have this attitude. Okay, Mr. Market, I've done my work. Prove me wrong. Okay, so challenge the market instead of making the market challenging, which it is. So you don't have to make it any more than it is. So that's about all I have to say for this morning. Good luck the rest of the day. And I'm wondering what Blake is thinking here. That's also part of, you know, how I've gotten better is, you know, hearing the guys every morning and seeing this work every day, wondering what some of the better traders are looking at, Grega and Andre. And so we have so much great research, Blake's stuff and Steve's stuff, and really think that it's to your advantage, not to our advantage, for you guys to have this at your fingertips. So I'll say this, and then I'm going to wrap it. Pay to learn or pay the market. That's your choice. How do I know? Because I've done it. All right, Blake, what do you think? Pay to learn or pay the market?
Hey,
Hey, buddy.
hold on one
Oh
second.
yeah, that's right. I forgot you were hung up a little bit this morning. So
yeah, I was just having a conversation with my office. So we're waiting
Kevin
on
K
Elvis.
says we're the best team on the net, Blake.
What's that?
Kevin K in chat says we're the best team on the net.
Thank you. I appreciate that. You know,
He didn't mean you.
you know, I'm
He meant
sorry.
the rest.
We were just,
The rest.
we were actually just having a discussion on Al's comments that are expected in the next hour. So, yeah, the thing is, you know, we're just talking about how, you know, everybody expects him to push back on negative rates, and so it shouldn't be anything that catches the market off guard, I don't think. You know, he's pretty good at kind of leading us down the path on what we should believe or what we should be thinking. But what we are seeing right now is the euro dollar reaching for, you know, for the highs of the session. One of the things that some of the comments that just came out from Merkel was, you know, pretty euro supportive, and that's something to think about, because, you know, the euro could squeeze, and I'm not if you guys been, you know, kind of hearing my comments for the last couple of weeks, actually this entire week and all of last week, I mean, I really haven't known how to play the euro, although I knew that I felt that the euro would be in a 110 to 108 range, and it actually held. I mean, you know, when we were up here at 110, I was telling one of my colleagues, and I even told you guys early last week, that we're going to be in a 110 to 108 range probably. And we got to 108 a lot faster than I thought. And now that we're at like the 50% retracement of this range, like, I don't know what to do. I know what to do. Not play the euro or the dollar right now. That's my you know, 2 cents at this moment, is just not playing this move. However, that's not to say that the dollar can't come under pressure, especially following, you know, this Powell testimony. If we break that 50% retracement, we might get a continued squeeze higher in the euro. Remember, like I just mentioned, the comments that came out from Merkel are very supportive for the euro. So that could allow for you know, the euro dollar to squeeze a little bit. Do I think that you know, that the euro's heading to 115? No, but, you know, could we still trade inside of this 110 to 108 range? I think it's entirely possible, and, you know, trading to the upper end of the range would not surprise me in the least bit. So that's something new to think about. As far as like some of these other pairs, like here's a cable. I mean, this is a, you know, a wedge. Very key support here at 122.50. Resistance is coming into play. You know, the Aussie dollar has spiked into some resistance. The Aussie's been very frustrating to play on the short side. Actually, I was short the Aussie New Zealand last night. I was playing this triangle. Following the RBNZ, we popped up to the 106.70 level. I sold a little bit here, and when it started to break above these highs, around above the 107 level, I got out of it. And I was telling the rest of the chat room, I've actually done really well shorting the Aussie New Zealand in the last couple of weeks. I think I've shorted it like 3 different times up around the 107 level, and, you know, made pretty good money on the downside every time. And then I thought I'd give it another whirl again, because it was post rate decision before the press conference. But, you know, when the RBNZ started talking about buying foreign assets, I was like, you know what, that's pretty dovish, and it's probably going to continue higher. So I took my loss last night as it squeezed higher. And now the fact of the matter is the Aussie New Zealand is in breakout territory. We're if you look at this weekly chart here, now that it broke the triangle, that triangle that we were following, and it was the chart of the day yesterday, it's actually breaking higher. And now I'm looking at the Aussie New Zealand, and this thing can really stretch its stretch its legs here. I'm let me put that up here. We're challenging the 88% retracement, and frankly, above 109, you know, we could trade up, you know, above 110. So I think it looks pretty bullish as a result. So, you know, just some things to think about, because like I said, I was trying to trade it last night. I was trying to fade this move before the press conference, and then even before the press conference, it started moving higher, and I'm like, you know, this thing looks like it's gonna go, and it has just continued to grind higher. And matter of fact, if you look at it, it looks like it, you know, I'm using the wrong lines here. It looks like it's probably going to continue to squeeze. I mean, this is a bullish wedge, right? Looks something like this. Yeah, it looks like it's going to continue to squeeze higher. So I wouldn't want to stand in the way of this. Matter of fact, I'd like to be long. I just, you know, I was actually looking when I got up this morning. I'm like, okay, if I get a dip down to 107.50, I'm going to try to take that. Excuse me. As a long, we haven't seen it yet. We haven't seen a dip like that, so I'm not getting it. Therefore, I'm just kind of standing aside. You know, and it was also, what was interesting is this morning I was talking to, you know, the guys in my office, and we were talking about the dollar, and one of the partners is like, man, I'm like clueless here, you know, as far as what to do with the dollar. And I'm like, yeah, me too. And that's why I'm actually focused more on cross rates at this time, not so much the dollar. But another pair that's dollar related that I think we have to watch, first of all, the US dollar and Norwegian krona is, you know, trying to break down. I mean, we're breaking some pretty key support. You can see the US dollar and Norwegian krona. I tried to play this on the long side. I got on the wrong side of it. But then I played on the short side yesterday and made a little bit of money. But the fact of the matter is, it's looking like it's breaking down right now. However, I'm not so enthralled right now with the US dollar Norwegian krona. I'm actually keeping a really close eye on this US dollar Mexican peso, because Aussie New Zealand's hitting highs. Okay. So this is the US dollar Mexican peso, and as I had mentioned, that we would have a short squeeze that we got when we got back above 24. Okay, we did, and yesterday it squeezed good. I actually played this on the long side yesterday and did pretty well with it. You can see the you know, the once we squeezed past 24, it was a really nice trade to the upside. I was wanting to play this on the long side down on a retest of the 24 level because it was a 618, but I didn't. But the thing is when it's consolidating above 24, okay, when it's consolidating above 24, that tells me that it wants to continue to squeeze higher. What I'm going to look for is you know, a move in the S&P. If the S&P starts to sell off, you know, the S&P starts to sell off, my number one risk off barometer is the US dollar Mexican peso. So if the S&P continues this move that we've seen in North American trade, we've seen, you know, Europe, you know, comes in and buys risk. North America has been selling risk. So if we see a continued sell-off in equities, I think you got to look at the US dollar Mexican peso as a long. And what's also going to help out with that is if the US dollar Norwegian krona actually turns. So what I'm trying to say here is, if you see the S&P, okay, you see the S&P do one of these, right? And then you see the US dollar Norwegian krona do a little bit of a reversal. Then I want to play the US dollar Mexican peso on the long side. Also, one other thing that I think you guys should be looking at is VIX. Okay, take a look at the VIX. Remember, well, if you were listening in yesterday, I was talking about this, you know, previous support acting as, you know, resistance. Okay, pressing pretty big resistance here. Now you can see that we're trying to, you know, get our head and stay above this, like basically this 31 level. So if we break this trend line resistance here, okay, if we break this trend line resistance here, that would tell me that the S&Ps are probably going to come under pressure, right?
Yeah.
Then that would also mean the US dollar Mexican peso is probably going to head higher. That means that the US dollar Norwegian krona is probably going to reverse course. Maybe, you know, we'll see. All right. So those are just like, you know, the pieces of the puzzle I'm trying to put together this morning. I'm trying to figure out something to do. But the missing piece right now is really the S&P. I want to see the S&P come down a little bit. Wow, this euro is strong. This euro is at its highs of the session. You know, we're at 80 right now, and you know, heaven forbid if we squeeze past this 50% retracement, you'll see we haven't been up here since the 5th of May. So beginning of last week, we haven't been up at these levels. The euro dollar could really squeeze. So just, you know, keep that in mind if you're trading the euro. I would be more of an advocate of selling the euro at 110. I have no interest in the euro dollar doing anything with it really at these levels right now. I guess the risk reward is to short the euro at the moment, as long as it doesn't breach that 50% retracement. You know, you don't want it to breach, let's just call it 108.90, you know, but we're only 10 pips away from there. And, you know, that there's a chance that we could do that. Another pair that is a little frustrating, but I'm trying to figure out how to play it, is the dollar Canadian, because we've seen a decent rally back in crude. Well, actually, let me take that back. We've had crude challenging basically the resistance here, right? So crude just continues to challenge this resistance right here. But if crude rolls over again, then I want to play the dollar Canadian to the upside. You know, I'd like to play it to the upside. I just, you know, it's in the middle of what I think is a triangle. So therefore, and you'll notice, by the way, a lot of these currencies are in ranges, and they're tightening in ranges. They're in triangles, pennants, and when you're in the apex of a, you know, of a triangle, this is extremely whippy, and especially right now at this very moment in time, we're in the middle. Oh, hold on. Mexico to start reopening economy on May 18th. Okay, that's just, I don't know if that's going to affect the peso. Looks like the peso strengthens on that headline. It's strengthening on that headline just a little bit. Yeah, it is. I don't know if you really want to be on the short side of that right now. I don't think that's gonna, I think that'll be very limited. Anyway, I guess going back to what I was saying about about these triangles, and going back to the dollar Canadian, we're in the apex of this triangle, and it's tightening, right? So the moves are going to be extremely whippy, and so we should be expecting that. That means that you try not to get too attached to any one trade. And you know, I'm going to leave you guys with one last thing that I try to do all the time. For me, I, you know, when I think about like my month in the markets, usually consists of 2 or 3 really good trades. Everything else is just, you know, chopping around. You know, it's like, you know, I make a little bit here, I lose a little bit there, I make a little bit here, I lose a little bit here. But the majority of the money that I make on a month-to-month basis usually consists of 2 or 3 really, really good trades, right? So if you think about that, and I don't know if that's the case with everybody, it just happens to be the case with me and most of the guys that I trade around with, right? In the office, we all are basically in that same boat, if you will. What I try to do every day is I try to find a trade that makes sense to me from a logical macro perspective. And I try to build into a trade that is going to be eventually a big, one of my big winners for the month, if you will. All right. And like, for example, one of the trades that I'm currently long, and I'm actually break even right at this moment, is I'm long the Euro New Zealand. I'm actually long the Euro Aussie as well. But ironically, I'm about break even in both, and I'm long just a little bit in both, not like aggressive. But I'm looking at this Euro New Zealand following, yesterday's RBNZ, and the way this pair works is it works more as a risk off proxy. So that means it tends to go up if there's risk off, right? So I'm looking at like this pennant. This is obviously a very big move from the RBNZ. Right now we're at about a 38% retracement. 50% retracement comes in at 179.35. What I'm more interested in is if we break the 181 level, which is the 78% retracement of this move, because then we're talking about, a move in the Euro New Zealand that could take us up to, 184, maybe even, the mid 180s again. And currently we trade at, 179. So I've got a small position, but I want to add to it. I want to add to the long side of this trade. I'm not adding right now because I'm not confident that things are falling in line the way that I want to see them. But this has the potential of evolving into one of the trades that makes me the majority of my money this month if everything works out. So what's got to work out for me? Well, I got to see the S&P start to show some signs of weakness. I want to see the Euro, claw back above 109. I want to see the Kiwi stay relatively weak. And so, if we break above this 180 and a quarter, I'll probably add a little bit. And if we break above 181, then I'm going to add more aggressively because I know that's a 78% retracement and channel resistance. So I think a breakout above here, and then it takes us back up towards, 183, 184. But you can see my idea as far as I have a small trade right now. And frankly, if it moves back below 179, I'll scratch it, take a little loss and, move on to the next idea that I think might develop into something bigger. So that's the thought process that I follow. And hopefully, that helps you guys with kind of the way I think about things and how I approach my trading, because like I said, I'm not like every trader. Every trader's, there's 1,000 ways to skin a cat. So when you talk about the markets, you can, I'm very much opposed to telling you that my way is the right way, because it's not. It's the right way for me. It may not be the right way for you. But what I've noticed in my trading is if I comb through my whole month, there's usually a couple of trades throughout the course of a month that made me the majority of my money. And those are the ones that I really try to focus on, or those are the ones that I really try to build something great into. So anyway, that's hopefully that helps you guys out. And with that being said, I'm going to bring in Stelios and Steve and back into
I don't even want to know the historical context under which there is 1,000 ways to skin a cat came out from.
Yeah, right. Yeah, right.
I don't know. Don't they say there are many ways to skin a cat, but Blake has 1,000 on his mind.
Yeah, but whichever of the two, I still don't want to know how somebody found out. I really don't want to know.
Oh yeah, taxidermist. Right?
Right.
Blake, you know what you were saying about, it's right for me, but it may not be right for you. So,
yeah.
I've interviewed Schwager a few times, the author of Market Wizard. And I remember, because I asked him and I said, Jack, what's the most important thing that you can tell traders? And he echoed what you said. Find a trading style that suits your personality. Okay, and here's a guy that's interviewed all the wizards, right? So, everyone's different, everyone's unique. Maybe day trading's better for you, maybe position trading's better for you, but you have to go through that process of discovering what suits
PPI
you.
a lot weaker than expected.
Oh, wow. Anyway,
Uh,
that's Jack Schwager.
Yeah. Jack is Jack is obviously the man. All right, so PPI came in a little bit weaker than expected,
minus
and
1.3% month on month versus minus 0.5 that was expected, and the year on year is minus 1.2% versus minus 0.2% expected. So, quite a bit, quite a big miss.
Indeed.
all right. Well, hey guys, I'm going to pass it over to you. Best of luck today. I'll see you on
Thank you, Blaker.
the daily roundup in a couple hours.
You're
Thanks,
going to
Steve,
have a cat
yesterday. What?
on the daily roundup? You're going to have a cat with you?
I will not. I'm an animal lover.
All right,
All right,
I'm
see
not
you
going to
guys.
say
All of
what
us.
other, if I was 20 years younger, I wouldn't call it a cat. Anyway, go ahead, buddy.
Thank you, Blake. Thank you.
Good luck.
Cheers, guys.
Yeah.
So good morning, everybody.
So Steve.
Good morning.
Hey. So we have a few things. To talk about. First of all,
First of
Jerome
all, don't
Powell.
you want to keep 1 minute of silence, Stelio, so
For
we
the
can
cat.
mourn about the CPI and the PPI undershooting. I mean, imagine the horror. People might actually have to pay less for what they buy. I mean,
Terrible.
horrible. I mean, destructive, really. I mean, imagine if you can buy the same stuff with less money in the future. Imagine.
Oh, that'd be terrible.
Yeah, I mean.
Yeah, you know what? People are still stuck on the fact that, deflation is terrible because, 50, 100 years ago, you could have spiraling deflation, which is really terrible. But with the way balance sheets and money supply keeps growing exponentially, that will never happen. Actually, no. I will not say it will never happen because everything has a probability of happening. But I think that's hugely unlikely. And tell you what, if I saw price of goods going down 10, 20%, I'd be buying everything I need. Just take the opportunity. Anyway, a few things to talk about this morning. First of all, Jerome Powell is due to speak in a couple of hours or something like that. The main point of that is negative rates. I think Trump himself tweeted yesterday about it. And
what didn't he tweet about?
Yeah, take a wild guess whether he likes negative rates or not. It's worth mentioning that Fed Fund futures are showing negative rates priced.
Exactly. That's how the conversation actually began, Stelio, because Fed funds are already discounting going negative.
It's only marginal, okay, very marginal, like a couple of basis
points.
But
still, yeah.
So that's what they're pricing, and you know how it usually works. The market goes ahead, prices something, and usually the central banks follow. Obviously, not always, but we've seen Jerome Powell push back on a few occasions in the past, but in the end, he kind of toes the line. So I wouldn't be surprised if the US do go into negative rates. I don't think it will help, but you know how it is. Even the RBNZ, who met earlier today, they kept rates at 0.25, but they doubled
it's a huge mistake, as already proven. So that makes me more or less certain that they're going to do it, because they have a propensity of they have the propensity of making big mistakes and then trying to improve things by making even bigger mistakes. So just by knowing that, I'm pretty sure they're going to do it.
Yeah. And talking about negative rates, the RBNZ kept rates at 0.25%, but they did pretty much double their asset purchasing program. And they did say that we could well have negative rates in the future. So they opened the door to that. And naturally, the Kiwi is underperforming today. So, we're seeing the same thing in pretty much all major central banks. They're going to zero. They might go to negative, buy everything that moves. I have a house here in Greece. If they want to buy at a good price, But you know, it's
where are mortgage rates in countries that have negative rates?
Good question.
They're positive. I can tell you that much.
Yeah, sure, they have a spread, but I was wondering
no, I mean
how much
the spread
of a spread?
Is
2 points?
No,
3?
more 300 basis points roughly.
Yeah.
Okay, so 3%, and money's costing them. Oh, the money's not costing them; they're getting paid on it. Okay, so they're getting paid on deposits, and they have a 3% spread, and they've had a bull market in real estate in Europe, and you know, I'm wondering how how these banks didn't make money.
I'll tell you how. A lot of those loans end up not getting paid ever, and then they're stuck like in Greece after the financial crisis, and then the banks are stuck with a huge portfolio of real estate, which it's a lose-lose situation. Because
you mean back from 2000, from the recession?
Yeah, from 2010. Yes.
All right.
Yeah. So they already have a big portfolio, and I bet that the situation is probably roughly the same in countries like Spain, Portugal, I'm assuming at least. So then they have to, either write some of it off, in any case being very slow in how they take advantage of that, because if they try to throw all that supply in the market is going to tank further. So you know how it is.
Yeah.
Or they have to create bad banks, which many countries have already done.
Oh yeah,
and throw all the bad assets in the bad banks. So whatever is left behind is more of a healthy bank, meaning the balance sheet is much healthier. In any case, you understand that it's not a pretty situation. And as I have been explaining in the past, Dale, the traditional model of banking and how banks are making money is completely broken and unfixable as long as monetary policy is what it is. Many things are broken and unfixable due to fiscal and monetary policy, but the traditional banking model is definitely on the top of the list.
Yeah.
You need a positive yield curve for banks to make money.
Exactly.
This is really nowhere.
And not only that, Stelio, if I may add, you also need one more thing: a free market discounting risk properly.
Yes. You know what? You want to laugh? I saw on Twitter a friend of mine from Barclays, where I used to work. He wrote that one of the instruments I used to trade was Sonia. So basically, this is the sterling overnight rate, which trades very close to base rate. So the official Bank of England rate, and there was a price today, 50 years of this swap trading negative. So 50-year rates at the minus something. And I'm like, oh my God, this is just crazy. But just shows you what the markets are doing and how they're looking into the future. And there seems to be no exit from this zero rate, buy everything scenario, which is crazy.
By the way, since you're talking about the market discounting and what that shows us for the future, let's add to that, Stelio, which is worth noting, that by the market discounting the federal funds rate being even slightly negative in 2021, it shows us that what we've been saying, that there cannot be an actual economic V-shaped recovery immediately back to where things were in January of 2020, for example, is more than obvious. Because if the market actually believed that the economy can rebound to what it was and completely erase, in essence, the damage done by the lockdowns, then there would be absolutely no reason for the market to discount a negative Fed funds rate in 2021, right?
Yeah, absolutely. My friend Nick's here is asking if I was at BZW. I was at Barclays in 2002 to 2006. Anyway, this is just negative rates everywhere, or zero rates, and central banks buying everything that moves. Okay, another thing today, we had Angela Merkel. Remember, she's not going to stand again to get elected, so she's leaving next year, but still everything she says is important. She talked about the recent decision by German courts regarding the ECB purchases and how they gave basically the ECB warning that they might not be. I don't want to say illegal, but they need to amend the whole process. And she said that European law takes precedence in many areas. But she did say she will respect the Constitutional Court's ruling on the ECB purchases. But so she's overall, I think what she's saying is positive for the euro. She says, I want a strong euro, and this is how we're going to proceed. She said the EU needs more integration, and treaty changes are not taboo. So she's open to change. I think overall the comments were probably positive on the euro, and we've seen the euro rally a little bit today. And in other news, oil. We had a joint Saudi and Russian statement saying that, and they stated that they're confident that the partners in OPEC are fully aligned with the goals and they will comply in order to bring price stability, et cetera, et cetera. So we're seeing again the Saudis and the Russians. Remember, they had a big fight. Was it a month ago? Now they're issuing joint statements. They're showing a bit more solidarity. And I think what we said about OPEC in the past will probably happen. That they're going to limit supply. They started with the 10 million barrels, whatever it was. They're probably going to add to that, and they will bring stability. I think that's without a doubt. The question is, where is stability? And I personally think we're going to be above $40 relatively quickly, but it might take a little bit of time because of the ongoing lack of demand due to the coronavirus. But as I said before, I think this is very constructive and is something to keep in mind. One last thing about data: we had the UK GDP today. Came in at -2% quarter on quarter, better than -2.5% expected. But we have to note that this was Q1, so it included very little, if any, of the proper lockdown.
Especially considering that the UK, for those that don't know, initially attempted to not close any parts of the economy and go through the path of following, the herd immunity theory. They partially changed their mind afterwards, but bottom line, Q1 in UK was even less affected than in other countries, right, Stelio?
Yes. But still, as I said before, we have to remember Q2 is going to be the big one because that's when the full lockdown was there.
Absolutely.
So, I'm really waiting for the next the Q2 prints in quite a few countries.
Yeah, they're going to be horrific. Yeah.
Well, let's see. And that's it. Pretty much, we don't have much else today. Weekly unemployment claims tomorrow in the US, always important these days. And actually crude oil inventories in about 2 hours as well. That's going to be interesting to see because eventually this is going to reverse in terms of, the buildup that's been happening over the past weeks. So that's about it.
Okay, perfect. Thanks, Tel. Time to jump on the charts. I'll start from crude since you mentioned it. Crude is still stubbornly, sticking on the $20 confluence of resistances. Doesn't seem to be willing to get rejected so far, but on the other hand, it hasn't broken out yet. So, looks to me like it does want to move higher, but it will have to prove in action that that's the case. In any case, I do believe that there is a big risk that shorts are going to be squeezed once we break through 20. I think we might find ourselves up in at 25, even 29, that previous support resistance area in very, very little time. So people should be very careful being short, and if they do, they need to have a proper risk reward ratio and be able to bail out if we do see a breakout. Natural gas, on the other hand, has been moving the opposite way during the past several days. Still hasn't invalidated the series of higher lows. After we got rejected from the 200 daily moving average, we've definitely seen a decent move lower. Now, there was also somebody here asking, which isn't a bad idea, we can do that. If we can have a look at the ratio, crude oil to natural gas ratio. And as you see, technical pattern is quite a big expanding triangle here. So we might be seeing more upside now that we've reversed. Yeah, something like that. You can see it. First area of resistance is roughly here. So that's about it. Now, we have VIX also failed at the 78.6. Okay, so let's start from stocks and the VIX, since you mentioned it, because we did have, near the end of the day, we did have a decently big move lower. At the same time, of course, the VIX exploded higher. This was a beautiful outside white candle on the VIX. You can see it. Intraday, we posted a lower low. And if you remember, I think it was at yesterday's webinar that I mentioned that the VIX tested this horizontal support resistance area as momentum was clearly stalling. And I said that I see here the potential of a descending wedge, which would imply at least a short-term rebound higher, perhaps even back to 55, 56. We haven't broken out yet from this descending wedge, but definitely yesterday's outside white candle, which, as a candlestick is a very nice bullish reversal candlestick, is warning that something like that may happen. Now, pay attention to this wedge trendline resistance. I think that's going to give us a good indication of what's happening. At the same time, as you see, the S&P did post a beautiful evening star formation, but it's still holding this previous low at 2830, also holding this ascending channel trendline support. So bottom line, potential for a reversal lower, not enough evidence yet. So I spoke about it yesterday also on the daily roundup. That's only for our members. And I said, there is the possibility of another little squeeze higher before we actually fail and move lower. That's still not out of the question. So, I mean, we might actually, fail from here, but I wouldn't find it unlikely to just consolidate a little bit longer and then produce another move slightly above 3,000, trap everybody else that's left being bearish in closing out their positions, perhaps even, trying to chase this market higher and then failing. In any case, I'm short because I've said many, many times during the last couple of weeks that the risk reward does not favor any more long positions. It makes no sense. There is only one way that makes sense at least in the short term, and that's lower. We are already way past valuations that we had 2-3 months ago because earning expectations have plummeted. So I'm short. My cost average is at 29.05, almost a little bit lower than that. And I'm absolutely fine with that. And I will be absolutely fine even if we squeeze a little bit higher. Probably I'm going to actually add to my position. So, still not conclusive that yesterday's plunge lower is the beginning of the next leg lower. It might be. We're going to find out soon. But in any case, risk reward definitely favors short positions. If we see a move above 3,000, I think that's a gift. And, I'm definitely not going to be wasting it. Now, the NASDAQ remains the strongest, but, you can see that yesterday was a beautiful failure. First of all, two things that you have to notice about yesterday in the NASDAQ is that, first of all, the NASDAQ first incrementally posted a higher high. You can see it here, okay? Second of all, not only it reversed lower to post a lower low and actually take out 2 days of price action and more, but it also closed right at the lows of the day. So in essence, what we got yesterday from a candlestick perspective is an outside Marubozu closing black, which is a very powerful reversal candlestick. Now, of course, a single candlestick is not enough to, to indicate a trend change, but it's definitely, a first sign, a first signal. Now, I'm paying close attention to this channel as well. We seem to be just below it. In any case, the risk-reward ratio against yesterday's highs is very favorable to look for a move lower, in which case, in the case of the Nasdaq, a level I would be looking for as a target would be 8,200. We have more areas of interest above it. It's 8,450. But in any case, I would expect a very decent pullback, even if that proves to be corrective in nature. So in any case, I made myself clear. I don't know if yesterday we started the next leg lower, but I think that even if we didn't, it's going to start very, very soon. Now, let me go through. We have questions about the Aussie and the Kiwi. I'm going to go back to the 4-hour chart and say what I said yesterday to our members. Here is the Aussie short term. That's the 4-hour chart. This might be another triangle, so I wouldn't be very much surprised if we saw another squeeze higher towards like 66.80, 67 cents before we fail. Here's the Kiwi. Kiwi yesterday, following the RBNZ, did move in the opposite direction, but still, this looks like a consolidation. Okay, so still not unlikely to see a little bit higher prices before we move lower, but I do believe we're going to be moving lower along with what risk assets are going to be doing. Now, the million-dollar question here is what kind of a move lower we're going to have, and we will have to let price action indicate what that move is going to be. Is it going to be corrective or is it going to be impulsive? And, just judge based on that. If you want to be holding these type of positions, or even if you want to be reversing to long positions soon after. USD INR not clear. Steve said it's bullish, but it's showing. Listen, all those assets like USD INR that you mentioned, for example, all these exotic currencies, they have pulled back from the highs, but it's still not unlikely. I mean, they're still in a consolidation. So it's yet not unlikely that we're going to see another push higher before lower. In any case, you can watch the triangle. If it breaks to the downside, then we can definitely see a move back towards 72 for the USD INR. Okay, but we first need to invalidate this series of high lows, meaning we need to see a move below 74. As long as we stay above 74, the technical formation hasn't really changed. Now, questions about the Euro Aussie and Euro Kiwi. We have questions about both. Listen, Blake covered me in that, and I've already said it in the past. Listen, Euro Aussie and Euro Kiwi have been the best proxies for risk. I've said it again and again. Forget the yen, because the yen is not anymore following risk closely as it used to. Perhaps it's going to go back to doing that at some point, but it's not doing it at the moment. I can tell you as a fact that Euro Aussie found support again at the 200 daily moving average in this horizontal support area. And as long as that's the case, I wouldn't be surprised to see another move to the upside towards 173. The Euro Kiwi, here it is, another attack on this descending channel. So, pay close attention to this one, because if we break through this channel, we might squeeze higher. And obviously, as I said before, in order for all of that to happen, we will need to see stock indices moving lower. And I do think it's probably going to happen. So Euro Kiwi at resistance. I would understand why somebody would want to be short here. I mean, from a risk-reward perspective, but my way of thinking here, since I expect quite soon a risk-off move, I would rather be buying a breakout to the upside than trying to short this test of resistance. But it depends on what kind of trading you want to do, what's your time horizon, etc., etc. So, I'm just telling you what I'm seeing, and each one of you is responsible of, making your own judgment and deciding on how you want to trade. The way
you know what, Steve? You know what my most important teaching is to mentees?
What is it, Coach?
I will not click the mouse for you.
Oh, that's the only certain thing. Absolutely.
That's a number one rule.
Absolutely. And each one needs to take responsibility for what they're doing in their trading account.
Yeah.
And I'm not saying that for regulatory reasons. I mean, I would say it even if that was not, something to take into consideration. We've said it many, many times. We don't. Ideally for us, we want people that subscribe to ForexAnalytix to get help become even better traders, and then not need us, but just be there to communicate with us and exchange ideas. And we're very lucky to have many of those traders with us in our chat room, exchanging ideas, having their own mind about what they want to be doing, but they know what they're doing. But in order to get to that point, it's something that, as you know better than anybody, it's something that needs work. You need to work on yourself, work on finding what suits you in terms of trading, starting with what kind of time frames you want to be trading and what type of trading you want to do, and then improving yourself until you consistently become profitable, which of course requires first of all to master trading with a proper risk reward, right?
Right. Also, Steve, a lot of these pattern and plays are like suggestions,
yes,
for entries and possible targets. But again, everyone has to learn how to manage a pattern and play or any other idea that's from themselves or others on their own. People have different styles, you piece in, piece out. Some people use trailing stops. So, learning how to manage a trade on your own is almost or even more important than your entry.
absolutely. I couldn't agree more.
Okay, buddy.
So, Euro Aussie, Euro Kiwi, as I said, they have the potential of exploding higher from here. Euro Kiwi at resistance. So, keep a close eye to those. Now, I haven't mentioned at all today, like some of the popular currency pairs, because they're still not doing absolutely anything. Euro USD still pointlessly oscillating in the 1075 to 110 area. The cable still undecided of if this is a triangle that's going to break out higher or if this is a head and shoulders formation that's going to break lower. So, there's no real momentum here in any of the, mainstream dollar pairs. And it makes sense because the dollar in essence is still trapped in a triangle in a consolidation. So personally, I'm not looking to try to micromanage and do some guesswork on what the dollar is going to be doing on a daily basis. I'd rather be waiting to see a legitimate breakout in one direction or the other, which I do think is going to produce some follow through, and that's going to be more worth trading. Now, I still
What's your
have
trading intuition telling you which way it's going to come out of this rectangle?
I think in the short term might be to the downside, but I do think that the dollar might keep on performing well. Depends on what risk does within the next few weeks to even few months. But I do believe that eventually, and of course we'll have to follow the technical pattern to decide when that eventually is. I think that the dollar is going to get disintegrated. So I expect that the dollar is going to enter another bear market, one of the very many that it has done since many years ago. I mean, just if we take the recent history from 1971, and
how about
abandoning
as a
the dollar peg.
technician? How about as a technician? It came down off a straight line move before the consolidation began.
Yeah, that's why I told you that in the short term,
yeah,
we might see a breakdown from there before we see perhaps higher prices. Not necessarily, but in any case, I expect that the dollar is going to fail miserably.
Well, I knew you felt that. I was just, you know what I was asking.
Regardless, I do have exposure in the dollar, and that's in the form of USD NOK. So I've been short the USD NOK, and I'm now quite nicely in the money. I like the fact that it's breaking down. It's currently testing the 61.8. I do think that we might see USD NOK move back to 950 quite easily. So, I do have some exposure, but what I'm saying is that I wouldn't have, exposure being short the dollar across the board. Not yet.
Okay. Yeah.
Not yet.
Okay, good point.
Right
now it's narrow weakness.
Yeah. We have several questions about USD CAD. Listen, the situation with USD CAD is quite simple from a technical perspective. This is a triangle. I think that as long as we remain above 138.50, we can easily see a break higher. Are things moving? Actually, did we have any news?
The gold.
Yeah, I saw gold, but
Euro breakout. It got through that resistance.
There it is. Gold currently testing resistance, by the way.
And euro.
Be careful there. Okay, we got some news I hear from Live Squawk here. I think that has to do with Powell saying, in essence, in essence, Powell saying that more measures will be needed, etc., etc. So I think that was what is pushing the dollar lower. In any case, USD CAD, I said it's a triangle. I think that as long as we trade above 138.50, it can break out to the upside. And since we got gold, popping up as an alert, keep in mind that gold is currently testing resistance. I still favor a breakout to the upside. I mean, this is a textbook triangle, and there is a high probability that it's going to break to the upside, with 1771 being the next upside resistance. Keep in mind that silver has already broken above the equivalent triangle. So in essence, gold is just going to be doing some catching up here. Let me see. Okay, coach, do we have a guest?
No.
Okay. Okay. Okay, I only have another 5 minutes that I can cover questions, because then I have to jump on an important meeting. So let me go through some of your questions very briefly, and then we call it a day. So USDMXN, we have a question about it. Listen, another triangle here, right? So not much to say. If we do get a decent move lower in stocks, I can still see USDMXN breaking to the upside, moving towards like 26, 27, and failing from there. Alternatively, if we actually break through like 23.5, that might have been it. This one here, let me mark it. This one here, this spike up there, might prove to have been the high. So that's an existing possibility, right? That spike higher. But as I said, there is still a decent chance that there is one more high missing here. With a move towards 27, we're going to fulfill, that technical possibility, and then I'm going to be very favorable in looking for lower prices in USDMX. And keep in mind that this is one of the trades that is also going to be paying you to hold it. So, Not bad, right? USD MXN, yep, covered that. We covered this. Hello, Steve. We've been following your recommendations and find your call just great. Now, what would you make you change from short to long on S&P out of curiosity? What would make me change from short to long in the S&P is S&P finding support at one of the downside levels that I'm looking for. For example, 2630, 2640 is an area of interest to me. And seeing an impulsive rebound from there. That's when I would be looking for higher prices. So, to begin with, I'm going to be holding my short position and pay close attention when we see a move lower in what kind of a structure we're going to be getting. Now, what would make me change to long positions without seeing a pullback? The answer is nothing. I don't mean that I don't have a stop loss or I won't take a loss to my short position if needed. But what I'm saying is that unless I see a decent pullback, for me, there is not going to be any risk reward being long. So worst case scenario, if I'm completely wrong, I'm going to take a loss in that short position, and I'm not going to be looking to go long chasing a market that's already stupidly valued without seeing at least a technical pullback that will, give me a better risk reward in participating in the long side. And keep in mind, of course, that the only reason that I'm going to be willing to participate in the long side is because, I don't connect in any case what's happening to, with the economy and the stock market, because they've completely decoupled. So, I'm not going to be taking my decisions based on my fundamental thesis of what's happening with the economy, because based on that, I would be looking for stocks to be cut in half from where they currently are. And I'm not exaggerating, but I know that's not going to be happening, of course. They're not going to let it happen, of course. I mean, no way. From a nominal perspective, they're going to do whatever they need to do to keep it, at levels that people are not going to be panicking and liquidating their 401ks, and pension funds are not going to be going broke, etc., etc. Democrats are proposing a new 3 trillion stimulus. Thoughts? Even if they compromise down to 1 trillion, will give another kick to the markets. To the markets, yes, I agree with you. To the economy, yes, a kick, but in the other direction, meaning kicking down the economy. Listen, I've said it before, and there are some people, there is a golden rule when you speak to people. Unfortunately, a lot of people get very passionate with politics. So speaking about politics is bad policy for doing business. Now, I like to be genuine, and I have the advantage of not being an American. So, I'm not voting one way or the other. And I have no problems pointing out mistakes from both sides, Democrats and Republicans. I can tell you two things. I don't see much of a difference between Republicans and Democrats having to do. I mean, both of them are in essence doing the utmost to be fiscally responsible. So it's just a bidding war. Who is going to promise more? You don't have. It's not that you have one party that wants to be fiscally responsible and the other one wanting to be fiscally responsible. In my eyes, they're both fiscally responsible, and they're going to definitely do huge damage.
There's a difference in who they want to distribute it to as well.
Okay, yeah. Okay, let's say I accept that, but I can tell you that in my eyes, as an economist, no matter which of the two not so different politic mixes you follow, the long-term prospects is for the economy to be much worse. That's in my eyes. So, I can say that because in essence, it's not a political thesis. I disagree with both of them having to do with economics.
Right.
As simple as that. Okay, take it as you
they have
wish.
Different constituencies. So also, I heard something interesting. We got used to, after the bailout and TARP and everything in 08, and Fed action calling it stimulus, which was done because we had a financial crisis that led to an economic crisis. And the money that's being sent out to people and businesses right now really isn't stimulus, it's a relief payment. Although it may have the same implications on the balance sheet, it may not be stimulus at all because it's simply just relief. It's a parachute. It's not stimulus. What do you think of that?
In general, I think that for a long time, developed
It's
economies
welfare.
have been following the totally wrong path to help citizens and the economies, and then they create problems with the policies that they apply, and then they have to invent even more of those policies to make a bad situation which they made bad be less bad. So in essence, they keep repeating, making one mistake to correct another mistake, but of course that never works.
Yeah,
So,
I mean, it is a little bit different. You know, the housing and derivatives and all of that in '08 is a little different than a public health crisis causing a financial crisis and an economic crisis. So really, what's the bottom line to really any kind of recovery?
I'll tell you what, the trigger is very different. There is no question about it. The underlying disease and cause is exactly the same, though. In both cases, we did not, I mean, because that applies to the vast majority of developed economies, have a healthy underlying economy. Because you know what? A healthy underlying economy can recover from something bad happening without everything blowing up around.
Like this, like a shutting down the world?
Absolutely. Absolutely.
We'll see about that.
Do you think that the US economy couldn't survive that in the end of 1950s, for example?
They already survived something like that. We lost.
A lot more than that, actually, right?
Yeah,
so depends on what kind of an economy you mean.
But I mean, really, Stephen, this is the first time you've seen the globe shut down?
Yeah. I mean, in essence, we had the globe shut down in the 40s due to World War II, right?
I don't remember.
Yeah. I don't remember either, but you know.
Not really, though. I mean, you had a transition industrial output going towards making weaponry, but you didn't have everything closed where people couldn't work because they were afraid of getting sick. So I'm just saying,
from the Spanish government left-wing party coalition to have hugely increased European minimum wage.
Guys,
here we go. I've told you before. I mean,
well, you think they're going to be able to stop sending people checks? I mean, I know the Republicans
trust me in what I tell you.
Yeah.
Minimum wage is excellent politics, horrible economics, horrible. I can give you 3 fast reasons and then I have to jump in a meeting.
Okay, go ahead, buddy. Yeah.
Minimum wage does the following. First of all, by law, keeps people that have low productivity out of the workforce forever. So let's say you have a minimum wage law of $15 per hour. Somebody that can't produce $15 per hour worth of work is legally moved out of the workforce forever. And the worst thing is that some of those people could actually end up producing $15 per hour productivity, but in order for them to be able to develop the skills to do that, they have to first have the ability to work for less. Now, it's a different thing talking about social politics. I mean, it would be much better, both economic politics, policy and politics, if you said that, listen, I do agree, I do expect that there is a minimum standard under which I don't want my citizens to be. It would be much better economics if you said no minimum wage policy, but people that are getting paid below X, I'm going to subsidize their income. Milton Friedman had an excellent suggestion about that. You can Google it if you want. You can find it on YouTube. It's called negative income tax. So Google that if you want. It's the concept of negative income tax. So it's much better for the economy and for the balance sheet of the government and for companies and for the worker to be able to work for as little as they can find, so they can develop skills and feel useful to the society instead of being constantly unemployed. And then they can be subsidized by government in that way. Then legally pushing people out of the workforce, telling them that if you can't produce $15 per hour, for example, you can't legally work for anybody, because that creates a lot more unemployment and marginalizes people, which also has, effects in society in general, and it's bad economics. It's good politics though, because people that do not lose their job because of that, they see an increase in the salary in their pocket. But as usually with good politics, there are a lot of people that cannot see that they will never get employed because of that. So there are people that immediately see a difference in their pocket and they're happy about it, but there are a lot of people that will never find a job and they don't have the knowledge to realize that there is a correlation between the two. Okay, coach, I have to jump on a meeting. Thank you.
Don't just count your pips, count your blessings. To be able to hear Steve's economic rants every day, I'm very grateful. It's a blessing to me. And everyone have a great day, okay? And we'll see you tomorrow. I have a pretty good guest tomorrow. He runs, David Keller is very good. You probably know him from stockcharts.com. So see everyone tomorrow. Have a good day trading, and see you, Deepak, DJ, James, Kevin, Sai, Monica, everyone. Thanks for hanging out with us today. I'll see you later. Adios. You're very welcome. Thank you, Scott.